Well, first up, everyone looks for what is their growth forecast, because if the growth forecast in the budget changes, I mean, if it becomes higher than expected, then automatically the percentage of the fiscal deficit will look smaller without you having to do anything. But that kind of a hint is not there. It's a very moderate, middle of the road kind of assumption of 6.5 to 7%. If you add the 4.5% CPI forecast of Reserve Bank and probably around a 3% WPI forecast, inflation is actually lower. So the 10.5% that they have gone with in terms of nominal GDP growth in the interim budget, there's no reason to change it. Even the tax buoyancy, which we were all expecting would get worked into the new numbers, if you're very modest in your growth aspirations or your growth expectations, I'm not even sure that the tax assumptions are going to be scaled up much. So if anything, the bond markets, after that initial enthusiasm, is back to where it was before the survey. There isn't so much expectation that there will be a huge cut in fiscal deficit. There is still the one-off RBI dividend. What they will do with it remains a question mark. But there is no extra assumptions that, oh, we can do welfare and we can do capex and we can cut deficit. That enthu has gone down a bit. With respect to stock markets, the big worry was about what do they think about the surge in stock prices. And there, the CEA leaves you in no doubt that he is worried about it. I'll read just two quotes, but I can pick 5 or 6, just at the snap of a finger. One quote, very serious warning on, the quote, the financialization of economies has not ended well, even for advanced economies. And then there are many, many examples. Another quote, all stakeholders, capital markets, regulators and government must ensure that capital markets play their theoretically assigned role of directing savings to their most productive investments. It is not just in the national interest, it is also in their selfish interest. So here again, saying what the SEBI chairman said, they must go for capex and must not go for speculation. And I'm only picking 2 points again and again. So clearly something will come now, whether it will come in the form of taxes or whether it is a directive from the government to tell SEBI, you better be a nanny regulator. We don't know. So that still leaves a question mark, but we are not in doubt that the F&O volumes and the market surge in general has not been taken too kindly by the government. And finally, there is some mention of inflation targeting. Remember, now the current inflation targeting framework targets 4% headline inflation. But there is a small paragraph which says that maybe we need to review that targeting and exclude food, because that can't be impacted by interest rates. And it is coming in a context where they want to encourage farmers. I mean, among the many things you can do to farmers is don't take off options trading at the first hint of, some commodity price going up. Don't ban exports at the first hint of a price rise. And the third thing they say is maybe you remove food from the inflation targeting scheme altogether and make the Reserve Bank target a food excluded inflation target. Well, I don't know if this is a very serious suggestion or it's just one of the many, but this is something the bond markets will chew over. It's not immediate, but we will have to wait and see. Those, I think, are the key takeaways. Okay, there's one on China, if you wish. On the external sector, when they discuss, they say that geopolitics, of course, dominates even our relationship with China. But rather than get into the China-dominated supply chains, which is what many nations aspire, let us look at encouraging FDI from China, because clearly exports out of China and imported into the US could be threatened sometime soon. And, if the Chinese money is routed through India in the form of a manufacturing investment, that may be one way to look at. Of course, this is subject to all geopolitics, but that's just a suggestion.